Okay, good morning. Welcome to Driving Markets. Okay, driving while talking about markets, but I'm not driving at the moment. It's not happening. Okay, let's kick off what happened yesterday. This is crazy. Okay, so the Fed increased interest rates by 25 basis points. All that was expected, was built into the price. We're already priced in, as they say. It's 0.25%. Okay, and there was a view last week that they're not going to increase interest rates because of the banking crisis, but eventually that view sort of faded away and then became the majority view they're going to increase interest rates. There was very little chance of higher than 25 basis points and very little chance of zero interest rate rise. However, the markets liked it and the markets initially went up. They responded well. Okay, why? Because Jerome Powell said more or less that is effectively the end of the interest rate cycle. There may be one more rise in March or April, but they're not going to increase interest rates anymore. The market loved it. The market went green. Everyone was hunky-dory. Everyone was happy. There was no issues, etc., etc. I didn't believe it, and I thought this is an absolute load of trash. Now, then the markets tanked. Absolutely tanked. Why did they tank? It's quite simple. They tanked because the Fed back in February, if you listen and you read what was said in February, it was very hawkish. They said that inflation is persistent. Inflation had already gone up when it was expected to go down, and they're going to continue with rising interest rates to the degree that several governors and several members of the FOMC stated that interest rates will have to go up a lot higher than expected, towards the 5.5–6%. I've been stating on this channel over and over again, rates need to rise to 6% minimum by June 2023. And yesterday, all of a sudden, the language completely changed. Jerome Powell, when he gave his post FOMC meeting statement, said that they're not going to increase interest rates anymore, and effectively by the end of the year they may even reduce interest rates. But inflation is going up, it's not going down. Inflation is persistent, it's hardcore, it's rock solid, and yet the FOMC found it that the need or stating that they're not going to increase interest rates anymore, and that is contradictory to the statement they made back in February. When you read into that, you begin to realize that the banking crisis is much deeper than we are aware of. The Fed is worried and scared and nervous that this banking crisis, which they're saying is only a blip, and Janet Yellen has stated everything's hunky-dory within the banking system. Remember, she said that there's no problems with the US banking system. The same woman, as I said over and over again, said back in January, February 22 that inflation is a transient issue and it's going to be finished by April 2022. But she got that wrong, and she got this wrong. This banking crisis is not going to end anywhere in the near future. The banks borrowed in the US $153 billion from the Fed in February. That's huge amounts of money. There is a liquidity issue, at least minimum, with the second tier banks. I don't know with the first tier banks, but there's definitely a liquidity issue with the second tier banks. As interest rates are rising, and as the tech stocks and the high risk assets begin to fall away, and the investments of those banks in these multi-assets that effectively have lost money in 2022, they are suffering liquidity issues. Those liquidity issues are only going to get worse. Okay, sorry for the bumps, but this is a pretty rough ride at the moment trying to stabilize the phone. Okay, remember this is raw footage, it's not edited. Right, so this liquidity issue is only going to get worse. So the banks have made pretty poor investments in 2022, like First Republic and like SVB, where they bought bonds at super high price, super low yield. Everything turned around where the yields went up and the prices went down. And in addition to that, as rates rise, more businesses are going to go into default and have difficulty repaying those loans. We're talking about second tier banks here, not first tier banks. Now the first tier bank, who have loaned money to all of the super multi-billion dollar companies, those multi-billion dollar companies have seen the net assets of those particular companies drop as a result in stock market valuations. And in addition to that, you're going to have a recession at least in the high-tech, high-risk sector. Amazon is laying off more and more workers. The high-tech sector is laying off more workers. Facebook, Meta, just last week laid off more workers, and you're going to have more workers laid off at Apple, at Google, at CRM, Salesforce, to name but a few, and including Microsoft. If there's not going to be layoffs, which there are, it's going to be minimum a freeze on hiring. You add all that together with the banking crisis and you've got a major problem, and the Fed is fully aware of it, and that's why they've laid off and showed signs of weakness when it comes to raising interest rates. Interestingly enough, when the markets were sold off yesterday, Bitcoin also came off, where recently people have been saying, or it's been all along in the media, that maybe Bitcoin is going to replace the banking payment system. Too premature, not going to happen in the near future. Bitcoin could see floating all the way back down to 22,000. At that level, the bulls will come back in and start buying it again. Based on present action of the Fed, you can expect a more severe market crash than stated previously. This is Mayor Valensky with Driving Markets. You can subscribe, you can share, you can comment, and I'll be more than happy to hear from you. Have a good day.